Okay, I'm very excited to be talking with Will Denyer. He is an economist and director of U.S. research at Gavekal Research. But interestingly, he does this from Hong Kong. Will, I know a lot of the study that you do is, I guess, more from a macroeconomic level because your feet aren't on the ground in the US. And frankly, that makes you a very interesting guest for me because one of the topics that I've been wanting to talk to someone about, which I think is an area that you could shed some light on, is this issue of a global savings glut. First of all, could you explain to us what that is and why we should really care about it?
Yeah, sure. Bernanke popularized the term, but he was really talking about the period after the Asian crisis to around 2005, so like 97 to 2005, and really talking about all of this savings that was coming out of Asia and pushing down interest rates around the world as a result of their policy responses to the Asian crisis. But actually, I kind of hijacked the term to describe a phenomenon that I've been looking at recently, which really dates back to the early 80s. And what it's talking about is basically a big demographic bulge of people in their prime earnings years, or what I call them, these are the middle-aged providers. These are guys and gals who are making a lot more money than they're spending, which allows them to save, of course, and then apply those savings to capital markets and push down interest rates, make capital more abundant. And so that's the savings glut I'm talking about, is the much longer term savings glut that we've seen, not just in Asia, but on a global scale since the early 80s.
So let's describe that in terms of how a person would see that himself. In other words, you're talking about someone who's actually got a pretty good job, earned pretty well. What happens that creates this glut?
One way to look at it is glut, and another way to look at it is just time preference. What happens is when you make more money than you need to consume right now, or you need to invest for yourself, you turn around and you invest in equities, you invest in treasury bonds, you invest in whatever it is. And when you do that, you provide capital to the financial markets. And, we learn with every other good out there, if you increase the supply, it tends to drive down the price. And so when you have all of these middle-aged providers providing a lot more capital to the system and not really demanding that much capital, supply goes up, demand goes down, and that drives down the price. So the price of capital, probably easiest to see in interest rates. You can also see it in earnings yields on equities, which is just the end of PEs. But basically, it's the cost of capital.
So wouldn't that actually ultimately help the equity market? Because if the cost of capital is low, that means that companies really are able to borrow money and invest that in building their business?
Absolutely. And it's also an opportunity cost issue. If these middle-aged providers are flooding the system with capital that they don't need right away, and they're willing to put it aside for 10, 20, 30 years and generate a return that they can then draw on, many years later in retirement, this pushes down interest rates. And not only, as you say, does that, drive down the cost of borrowed capital for companies, but those same flows of capital are also propping up equity prices. As you push up equity prices, that's pushing down the earnings yields for companies. So absolutely, the same flow of capital is bidding up the price of bonds, and it's bidding up the price of equities.
We're speaking with Will Denyer from Gavekal Research based in Hong Kong. He's been talking to us about how people in their middle ages, I guess, that would include me, Will, who are doing okay and they're actually earning more than they are spending, are able to invest money. And this money is rushing towards the markets, whether it's going into the stock market or even into the bond market. And as a result of this flood of money going in, that's actually helping to push up the price of the stock market, which is maybe something we've seen recently, and it's helping to lower interest rates, which the effect of that means that it's easier for people as well as companies to borrow money and then to use that money to build and invest in the future. So this feels kind of like a positive thing. But one of the areas I know that the Fed is afraid of is that we're in a potentially inflationary environment. Is that something we need to be worried about?
Potentially. I think the way I'm looking at this is, you've heard the term the Great Moderation. This talks about the period from the early 80s until today, where we saw interest rates grinding lower and lower and lower. And the Fed and other central banks like to take a lot of credit for causing that. And I think they obviously played their part. But I think a lot of it had to do with just this flood of capital that's been coming in from this bulge of the population in the middle-aged providers. And by the way, I don't think I've given ages on that yet. It's roughly around 35 to 64. It's strongest in the middle of that group, and then it's a little neutral around the edges. But that's roughly the period that I'm talking about. You can think about, if you're in the US, you think about the baby boomers. The first of the baby boomers started to turn 35 right around the early 80s. And then from then on, that group just grew and grew and grew as the baby boomers entered that peak providers age. And so, I think that helped moderate interest rates. It may have also had an effect on inflation, although that one's a little bit trickier.
I just want to clarify what you're saying. When you're saying that this is a demographic change, that there are people who are hitting the age where they are in their maximum earning potential, earning more than they need, and that's creating extra cash that's available for investment. That was your thesis at the beginning. And now you're pointing out that that's actually helping to push interest rates down. And my question is, because actually this is very interesting, the Fed, you said, and other central banks, is taking credit for properly manipulating the interest rates in order to get rid of the problems we had in 2007, 2008, 2009. What actually has more of an effect on interest rates? Is it the central banks who really can control interest rates because they just name the price that money is going to cost? Or is it the market?
I think in the short term, the central banks have a lot of power to adjust interest rates, no doubt about it. But I think structurally speaking, I think demographics are not given enough credit for really driving the big structural moves in interest rates. And, we've been talking a lot about the past now, and I've described this bulge of the population that drove interest rates down since the early 80s and propped up equity prices structurally since then. But actually, what I probably should get to is the news today. And the news today is that is actually yesterday's story. That bulge in the population is now actually moving out of that middle-aged providers ratio, not middle-aged providers ratio, middle-aged group. And they're starting to retire, which is, of course, not news to anyone. This is a popular story. And so now, whereas before an increasing portion of the population was basically net providers of capital, which again was great news for financial markets, that group that's net providers is now starting to shrink, okay, relative to the consumers of capital. And the consumers of capital are the retirees who are drawing on their savings and the younger people who are either not making anything at all or not making a lot. And at the same time, they're demanding a lot of investments as companies and individuals invest in houses, factories, office buildings, software in order to take advantage of this new young population. So again, coming back to just simple supply and demand, we had a period from the early 80s till now where we had capital abundance. Supply was growing relative to demand. I think that's now changing. So we could actually be at a structural turning point now where we start to see interest rates rising. And I'm not just talking about Fed policy. How many rate hikes are they going to have next year? I'm talking about the next 20 years.
Interesting. So this potentially is a turning point. You're saying that whereas there had been a flood of money that was keeping interest rates low and therefore helping the stock market, it's possible we're entering a period that's the opposite. And you're saying the demographics seem to prove that because the people who were earning this extra money are now going to be spending a lot of that money. So there won't be a flood of cash into the markets, but the opposite, it'll be coming out. And that could have the reverse effect on interest rates and, in fact, the reverse effect on the markets as well. Interesting and a little bit scary, but it's something I certainly want to dive into more. But unfortunately, we are just about out of time. But Will, tell us, how can people follow you and follow your work?
Absolutely. Please come check out our company website at www.gavekal.com. That's Gavekal.com. And I'm actually brand new to Twitter. I tried to avoid it for a while and finally gave in. So I've just joined Twitter. You can find me at Will Denyer.
We'll put links to that at the show notes of today's show. Will Denyer, thanks so much for taking the time.
My pleasure.
You've been listening to the Goldstein on Gelt show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.